Development Pharmaceuticals in association with Higher Secondary Principals Forum.
Welcome students to accountancy class. I am Mrs. POOJA CHURI from Saraswat Vidyalayas Purushottam Valarkar Higher Secondary School, Mapsa. So today we are dealing with the topic retirement of a partner. So already you have learned the basic chapter in partnership, also admission of a partner, and you all know that partnership is formed by a mutual agreement between the partners to carry on the legal business. It can be formed at any time when two or more persons desire. So in other words, a partnership is always at will of partner, and it is possible that one of the partners may express his inability to continue in the partnership and request the other partner to allow him to retire from the firm. So as you can see on the screen here, that I have shown the picture wherein the partner is retiring. The person who has cut off his relation from the business is known as a retiring partner, and the persons who remain in the business are known by different terms. They are called as remaining partners, they are called as continuing partners, or they are called as gaining partners. So let us see in details. In the next slide, you will see the meaning of retirement of a partner. So now here, this retirement or death of a partner leads to reconstitution of partnership firm. So reconstitution means change in the agreement. Is that clear? So partner may retire from the business due to various reasons. So there can be illness, or due to maybe old age, or maybe misunderstanding, or for any other reason, or maybe he wants to start his own business. So due to various reasons, he may retire from the business. Now section 32 subsection 1 of Indian Partnership Act, now partner can retire with the consent of all partners or in accordance with the express agreement among the partners, or by giving a notice of his intention to retire from the partnership at will. Now what are the various adjustments? As you have learned in admission of a partner, the various adjustments, so also in retirement you will have to learn the various adjustments. So what are these adjustments which are required? So first is calculation of gain or new profit sharing ratio of the remaining partners. So gain ratio, we will see in details about these ratio calculations later on. Then treatment of goodwill we have to see. Then in details again the other adjustments like treatment of accumulated losses and profits, which you have already learned. Now treatment of goodwill is not same as admission of a partner, so it is slightly different. So we will see in details also. Then revaluation of assets and liabilities, it is same as you have learned in the case of admission of a partner, but here only difference is in admission the revaluation profit or loss is distributed only between the two partners or the existing partners before admission of a new partner. But here before retirement we distribute the revaluation profit or loss to all partners before the partner retires. Then we have calculation of total amount due from a retiring due to a retiring partner and settlement of his capital accounts. So now you will learn in details how the amount, what is the amount payable to a retiring partner. Then next is adjustment of capitals. In adjustment of capitals, when partner retires, the remaining partners may decide that their capitals to be adjusted in the new profit sharing ratio, that also we have to do. And finally, retiring partner's loan. Suppose if we transfer the balance due to retiring partner to his loan account, then his loan account has to be settled. Okay. Let us see from the beginning now calculation of ratios. So there are various ratios you have to calculate. Number one is new profit sharing ratio, and secondly it is gaining ratio. So under new profit sharing ratio, what is new profit sharing ratio? When a partner retires from the firm, the remaining partners have to share the profits in a certain ratio. So that is the ratio which is continuing partners will share in the future profits after the partner retires. Okay, so it is required to be to adjust the capitals of the remaining partners in future in the new profit sharing ratio, and that is the purpose for which you require new profit sharing ratio. Sometimes when you have to calculate the gain share of a partner, you also need to know the new share of a partner. So when we calculate new profit share, there is a formula that old share plus gain share. Now new share is always more than the old share, because when partner retires, now his share will be shared by the existing partners. So naturally their existing share will increase after the partner retires, and therefore new share is always more than old share. And therefore when we calculate the new share, it is new share is equal to gain share and plus old share. So now there are various situations under which you have to calculate this new profit ratio. Okay, so let us see the first situation. What is this first situation given to you? Says when merely old profit sharing ratio of all partners is given. Okay, so now suppose if there are partners, two partners, and they are sharing in a certain ratio. So only that is given to you. Then how do you calculate? So what rule says, in the absence of any information regarding future profits ratio among remaining partners, it is assumed that they will share the future profits in the old ratio. So what does it mean now? That old ratio itself is a new ratio between the same partners, okay, meaning the existing partners. For example, now here one example is given to you. X, Y and Z are partners, and they are sharing profits in the ratio of 3:2:1. Now Y retires, the middle partner retires. Calculate their new profit share, that is between new profit ratio between X and Z. So now let us see the solution. Now all of you know that Y retires, so only X and Z remains. So what rule says? The new ratio is same as old ratio. So how it will be shown? When Y retires, the new profit sharing ratio between X and Z will be, after dropping Y share, it is 3:1. Similarly, suppose if you are asked Z is retiring, then what will be the ratio between X and Y? It is 3:2. Very good. Yes. So now suppose if X retires, then what is the ratio between Y and Z? It is 2:1. I hope it is very clear to you. Now let us see something different here. What is given here? Please all of you go through it. If fractional proportion between old partners is given, then form the ratio by equalizing the denominators to ascertain the new ratio. Is that clear? Meaning what? Suppose now in this problem directly it was given 3:2:1. Okay, so it was very easy to drop the share of a retiring partner and form the ratio between the remaining partners. Now if fractions are given, how do you form the ratio? Then what you have to do? You have to make the denominators equal, then form the ratio, and then drop the share of retiring partner, and then know the new ratio between the remaining partners. So let us see one small problem here. So let us take a problem. It is calculating new profit sharing ratio between P and Q after R retires. The profit sharing proportion between P, Q and R given to you as half, 1/3 and 1/6 respectively. Okay, so now let us see this. When profit sharing proportion is half, 1/3 and 1/6. So to make the denominators equal, so let us take 6 as a denominator, because that is a actually lowest factor when you multiply it with 2 or 3. So in the first case, in P's case, to make the denominator 6, we have to multiply it with 3. So when you multiply denominator with 3, numerator also should be multiplied with 3. So in P's case, it is 1 multiplied by 3 and 2 multiplied by 3. Similarly, Q's case, you have to multiply both denominator and numerator with 2. And R's case, you don't have to, I have just shown it as multiplied by 1. So what is the ratio between P, Q and R? It is 3:2:1. Now when R retires, we have to form the ratio between P and Q, and that is 3:2. I hope this is clear to you. Next is, let us see the second case when old profit sharing ratio of all partners and actual share gained by each partner, remaining partner from retiring partner is given. Meaning what is given here? You are given the old profit sharing ratio and also given a gain share. The actual gain is given to you. So you don't have to calculate the gain. So directly it is given to you, and you know the old profit sharing ratio. So profit share, old profit share is also known. So what is the formula we use to calculate new share? New share is equal to old share plus share gain. So let us take this example. M, N and O are partners sharing in the ratio of, okay, what is it? 5:3:2. Now O retires and M gains 1/28 from share and N gains 3/28 share from O. Calculate new profit sharing ratio. So let us see the solution. So what is the formula we follow? New share is equal to old share plus gain share. So if M's new share we have to find out, it is already known 5:3:2 is the ratio, right? So 10 is the denominator. So 5/10 is the M share. So 5/10 plus gain share. So gain share is directly given, it is 1/20. So if you add both, so then what do we get? So now 20 is LCM, meaning the lowest common factor. So when you have to make the additions of fractional numbers, we have to make the denominators equal, right? So it is already taught to you in details in admission of a partner. So let us see this now. If we have to make that denominator 10 as 20, then we have to multiply it with 2, and also numerator also should be multiplied with 2. So it becomes 10/20. So 10 plus 1/20 is equal to 11/20. Same way we do for N also. N's new share is 3/10 and his gain share is 3/20. So his new share should be a denominator. To make 20, we have to multiply it with 2 again. So numerator also should be multiplied with 2. So what do we get here? 6/20, right? So 6 plus 3/20 is equal to 9/20 is the new share of a N. Okay, so what is the new profit sharing ratio between the partners? It is 11:9. I hope this is very clear to you. This is the case. Now when old ratio and gain share is given, directly we add old share and gain share and find out the new share and then form the ratio. Okay. So now let us go for the next. When old profit sharing ratio of all partners and gaining ratio of remaining partners is given. Okay. In fact, this is the third case. By mistake it is given as number 2. So in the third case, what is given to you? Old profit sharing ratio of all partners and gaining ratio of remaining partners is given. That means here gain share is not given directly, it is gaining ratio is given. So now what is the step you have to follow? First you have to calculate the gain share of each partner, remaining partner, and then you have to use the formula as new share is equal to old share and then is equal to old share plus gain share and then find out the ratio. Is that clear? So let us take this example. Varat, Samar and Kumar are partners sharing profits in the ratio of 2:2:1. Kumar retires and his share is gained by Varat and Samar in the ratio of 1:3. Now and you have to calculate new profit sharing ratio. Now you see here, when ratio is given as 1:3, now this ratio is whose share they are sharing in the ratio of 1:3? It is Kumar's share, because Kumar retires, right? So we have to calculate the gain of Varat and gain of Samar. So how do we do this? So let us first see Kumar's share is of given is 1/5, right? And this 1/5 is shared by them in the ratio of 1:3. So what is Varat's share in Kumar's share? 1/4 of 1/5. Is that clear? So, of meaning multiplication, all of you know that. So, 1/4 multiplied by 1/5, so we get 1 upon 20, and Summers gain, how do we calculate? 3/4 of 1/5, that is 3/4 into 1/5 is 3 upon 20. So, we got the gain share, and further we have to calculate the new share. You know the formula, very good. It is old share plus gaining share. Yes, correct. So, here we will do it 2 upon 5 already known, because 2:1 is the ratio. So, out of 5 2, like 2/5 plus 1/28. Okay. So, 20 is the denominator, isn't it? LCM, lowest common factor, is 20. So, we multiply 5 to make it 20. We multiply it with 4. So, numerator also multiplied with 4. So, it is 8 upon 20. So, 8 plus 1 upon 20 is 9 upon 20. Correct. Very good. So, let us do it for summer also. 2/5 plus 3 upon 20, that is 8 plus 3 upon 20 is equal to 11 upon 20. So, we got the share, new share of Varat as 9 upon 20, and Summer's new share is 11 upon 20. So, ratio between Varat and Summer will be, of course, yes, very good, 9:11. Now, what is the next thing we have? When new profit sharing ratio is specified. So, it is when directly given, you do not have to calculate, no. So, when given, no need to calculate. So, let us see this problem. A, B, C are partners sharing profits in the ratio of 4:1:2, and B retires. The new profit sharing ratio of A and C is given as 5/8 and 3/8 respectively. So, it is already given to you, so no need to calculate. So, a new profit sharing ratio is given between A and C, and it is 5:3. Okay. So, let us see now what is gain ratio. Okay. Now, gain ratio, now you see that already there are partners, existing partners, and one of them if retires and one of them leaves, you know that the other two partners will get more share in the profits. For example, now suppose if there are A, B, C are partners, and C if retires, and the profit of the firm earned by a firm is suppose 12,000. So, if the profit sharing ratio is equal, then if all three partners are there, then all three partners will share it equally, that is 12,000 equally. So, 4,000, 4,000 and 4,000. Suppose C retires, and if the profit is also remains same in the next year. Now, there are only A and B, and profit is 12,000. So, between A and B the profit will be shared, now suppose equal only ratio, and then it will be shared as 6,006. So, earlier when C was there, they were getting 4,000 each, but now when C retired, they are getting 2,000 more, that is the remaining partners. So, like that the remaining partners are going to gain, they are going to acquire the share of the retiring partner, and that is actually the gain. And when we form the ratio between the remaining partners, then we call it as a gain ratio. So, it is the ratio in which the remaining partners gain in the share of a retiring partner on his retirement. Now, why do we require this gain ratio? We require this gain ratio to adjust the goodwill of a retiring partner, because when a partner retires, he has to get his share of goodwill also, no. Now, how this share of goodwill will be compensated by other two partners? Of course, in the gain ratio. Very good. So, now here in gaining share, when we calculate gaining share, what is the formula then? New share minus old share. Is that clear? So, let us see now the calculation of gain ratio. Now, let us see the first situation when merely old profit sharing ratio of all partners is given. Okay. What does it mean now? Suppose if there are three partners, only their old ratio is known and nothing else is known, meaning you are not given any new ratio, you are not given any anything else. So, in that case, it is assumed that the partners, existing partners share the future profits in the old ratio itself, meaning old ratio and new ratio of existing partners is one and the same when this is the situation. So, when you know now old ratio and new ratio, then of course you get the old share and new share of existing partners, and you can use the formula of a gain to calculate gain, and you can calculate it. So now let us see this. X, Y, Z are partners sharing in the ratio of 3:2:1. Y retires and calculate the new profit sharing ratio of X and Z, right. So let us see this solution. New profit sharing ratio between X and Z will be 3:1. After dropping Y share of 2, right. So now what is the formula of gain share? New share minus old share. So after dropping Y share, X share is 3 and Z share is 1. So what is the ratio? 3:1 between X and Z. That is a new ratio. And what is their old ratio? 3:2:1. So what is the old share of X there? It is 3/6. Whereas what is his new share? 3/4. How? Because earlier it was between 3 partners. So what is the total of 3 is 3, 2, 1, 6. So out of 6 he received 3. So that is 3/6 is the old share. And in the second ratio, that is in the new ratio, it is 3:1 only, no. So what is the total? 4. So out of 4 he is getting 3. So 3/4. Is that clear? So now this is the thing. So gain share is equal to new share minus old share. So what is his new share? It is out of 4, 3, and old share is out of 6, 3. So 3/6. Okay. And then when we solve this subtraction for a fractional numbers, you know that we have to make the denominators equal. So lowest common factor, and then we multiply the numerator also with the same number to get the denominator. So 9 minus 6/12. Okay. It is 3/12. Is that clear? So I hope this is clear to you. X gain, right? So Z's gain. It is again the same thing we are doing. His new share is 1/4 X, Z's new share, and Z's old share is 1/6. So again this is a fractional subtraction. So we make the denominator 12 because that is the lowest common factor. So multiply it with 3, that is 4 into 3 and 1 into 3. So 3/12 and 2/12 because we have to make that 6 denominator as 12. So multiply it with 2. Is that clear? So 3 minus 2/12 is 1/12. So both gains we have got, and we form the ratio now between X and Z, that is 3:1. Now whatever we have done now on this, in this case, that is in this situation, see what we can find out here is, if you see here, X and Z share the old profits in the ratio of 3:1. Their new profit share is also 3:1, and their gain is also 3:1. So we can draw one conclusion. So all of you just have a look at this note which I give you here. When merely old profit sharing ratio of all partners is given, then the new ratio and gaining ratio of remaining partners is same as their old ratio. What does it mean now? The old ratio of remaining partners, the new ratio of remaining partners, and the gain ratio of remaining partners is same. Now let us see the second situation. When old profit sharing ratio of all partners and new profit sharing ratio of remaining partners is given. Now when you know the old profit sharing ratio and new ratio, you know obviously you know the new share and old share. So what is the formula? Yes, very good. It is gain share is equal to new share plus new share minus old share. So same formula let us use now. A, B, C are partners and their profit sharing ratio is 4:1:2, and B retires. So now when B retires, A and C share their new profits in the ratio of 5:3, that is 5/8 and 3/8 that is given to you. So let us solve it. Gain share is equal to new share minus old share. Okay. So let us find out what is A's gain. A's gain is his new share minus his old share. So again the fractional calculations are there. So we have to form the, we have to know the LCM and then calculate it. Okay. So let us see A's gain is equal to 58 minus 4 upon 7. So LCM is 56, that is the lowest common factor of 8 and 7. Okay. So to make this denominators 56, we have to multiply the first fraction with 7 and second fraction with 8. Okay. So when you multiply with numerators, it is 35 minus 32 upon 56, that is 3 upon 56. That is the share of whom? A. Now what is C's gain? Same. 3/8 minus 2 upon 7, 56 is LCM. So it is multiply 8 into 7 and 3 into 7, so it is 21 upon 56, and multiply 7 into 8 and 2 into 8, that is 16 upon 56. So 21 minus 16 upon 56 is equal to 5 upon 56 is the gain of C, and when we form the ratio between A and C, it is 3:5. Yes. Now we have seen calculation of new profit sharing ratio between the existing partners. We have also seen the calculation of gain ratio between the existing partners. Now let us go for the next accounting adjustment, that is treatment of goodwill. Now all of you have learned goodwill concept in the chapter admission, isn't it? So already it is taught to you. You have learned what is goodwill, you have learned what are the factors determining goodwill, you have also learned the various situations in which the goodwill is to be valued, you have learned the various methods for calculation of goodwill, and finally you have learned the accounting treatment of goodwill in admission of a partner. So all of you know that goodwill is the reputation of the firm, that is a simple meaning, but in terms of partnership firm, what is it? It is the super profit earning capacity of the business, which attracts, it is a force which attracts more and more customers, wherein the business gets increased, the sales increase, and so also the profits of business. So it is always related to profit, all of you know that. So let us not go in details. You have learned in details the calculation valuation, simple profit method, then average profit method, then you have learned super profit method. So all these calculations, we are not going into details of calculations of goodwill. We will see only the treatment of goodwill at the time of retirement of a partner. Okay. So what is it? When retiring partner actually has to leave the business, he should get his all shares existing in the business, because he has made efforts, isn't it, to bring the company to bring the firm into existence. So he also should get his share of goodwill, because he was a part of that business, isn't it? So to establish that goodwill, he had his efforts. So therefore he should also contributed, he has also contributed in gaining the goodwill. So hence the goodwill of the firm is valued as per the agreement among the partners, and retiring partner is compensated with his share of goodwill by the continuing partners in the gaining ratio. Now you will know why gaining ratio was important for us to calculate, isn't it? So because now the retiring partner should be given his share of goodwill, so who will compensate? The remaining partners will compensate. So how they will compensate? Of course in the gaining ratio, right. So now here what should we do then? Because it is related to partners without opening goodwill account, we are directly adjusting the goodwill to their capital accounts. Since remaining partners have to give the share, so they are like debtors, right. So they have to be debited, their account has to be debited, and retiring partner has to receive, so he is like a creditor, so he should be credited, his account should be credited. So when we pass the journal entry, always the gaining partners are debited and retiring partners should be credited. So that is what it is given here to you. So now let us see some examples how do we treat the goodwill, how do we calculate it, and then what journal entries we pass, what is the effect of this goodwill on the ledger accounts of partners. Okay. So, as far as balance sheet is concerned, we do not have to show any goodwill in the balance sheet. Okay. So, or we do not have to even adjust the goodwill in the balance sheet. So, let us see now one transaction. Okay. The first is for adjusting retiring partner's share of goodwill, that is the transaction. Okay. So, what is a journal entry? It is already known to you. Always continuing partners should be debited in their gaining ratio and retiring partners should be credited. Okay, let us see the example, students. Mahesh, Naresh and Ojas are partners sharing profits in the ratio of 5:3:2. Naresh retires and his goodwill, the firm's goodwill given to you is 40,000 and Mahesh and Ojas share the future profits in the ratio of 3:2. Now, what is given to you here? Mahesh, Naresh and Ojas, old profit sharing ratio is given. Then you are given the goodwill of the firm. Who retires? Naresh retires. And what else is given? New profit sharing ratio between Mahesh and Ojas is given. So, in this case, what we have to do first? We have to calculate the gaining ratio. So, you know gaining ratio because old profit sharing ratio and new profit sharing ratio is given, isn't it? So, new share minus old share. So, let us see this. In Mahesh gain, how do we calculate? His new share is 3/5 minus his old share is 5/10. So, to make the denominators equal, that is 10 is the LCM, and then what we do is we subtract, that is old share from the new share, that is 6 minus 5/10 is the common denominator. So, it is 1/10. Okay. Ojas gain, how do we calculate? Again his new share minus his old share. So, LCM is 10. So, to make the denominators equal, you know that how to calculate. So, 4 minus 2/10. So, 2/10 is the share of Ojas. So, we know their gain share. So, what is the ratio between Mahesh and Ojas? It is 1:2. Is that clear? So, now what is the next thing given to you? You are not given retiring partner share of goodwill. What is given to you? You are given the total goodwill of the firm. Okay. But if we have to calculate Naresh goodwill, then what we have to do? This is the formula. Firm's goodwill, multiply it with his share of goodwill. His share, meaning his profit share. So, what is firm's total goodwill? Given 40,000. What is his share? You know what is Ojas share, Naresh share, isn't it? What is it? 3/10, right. So, how do we calculate the Naresh goodwill there? 40,000 multiplied by 3/10 is equal to rupees 12,000. So, we know that Naresh goodwill is rupees 12,000. Now, this goodwill should be distributed between Mahesh and Ojas in the ratio of 1:2, that is a gaining ratio. Okay. So, what is the gaining ratio? 1:2. We have already calculated, all of you can see there, students. So, then what is the share of Mahesh there? 1:2 meaning 1/3 is of Mahesh and 2/3 is of Ojas. So, 1/3 of 12,000, okay, how much it is? 4,000, and 2/3 of 12,000 is 8,000. So, is that clear? So, their goodwill share, meaning the compensation they are going to make in favor of what is it? Retiring, that is partner, that is Naresh, is 4,000 and 8,000, and for this we have to pass the journal entry. Okay, in the next slide I will show you how to pass the journal entry. Already you know what is a journal entry. Continuing partners capital account is debited and retiring partners capital account is credited. So, who are continuing partners here? Mahesh and Ojas, and who is retiring? Naresh. So, Naresh should be credited and Mahesh and Ojas should be debited. Okay. So, all of you just have a look at this journal entry. So, what is the journal entry? Mahesh capital account debit, Ojas capital account debit, Mahesh share is 4,000, Ojas is 8,000, just debit that amount, and Naresh is credited with rupees 12,000. So, how do we distribute it? That in the gaining ratio. I hope this journal entry is very clear. Okay. Now, how do we show the same in their ledger accounts? So, when you open partners capital accounts, we open it in a columnar form for all 3 partners, and the same entry, like last year you have learned the contra entry for cash and bank transactions. So, it is somewhat similar, like it will appear on the debit side as well as credit, because we are always opening the combined capital accounts of partners. Okay, so it will appear like this. All of you see here on the debit side we have Mahesh, Ojas and Naresh. On the credit side also Mahesh, Ojas and Naresh. So, Naresh retires. Okay, he should be credited. So, how the same will appear here? So, let us see this same adjustment in the capital accounts of partners. So, all of you can see the journal entry there. What is it? Mahesh is debited, Ojas is debited and Naresh is credited. So, when we prepare the ledger accounts of partners, we prepare it in a columnar form. Both the sides, capital accounts, we have to record this journal entry, make the posting of this journal entry. So, it will appear like this. Now, see here, who is debited in this case? Mahesh is debited and Ojas is debited, right? So, same will appear on the debit side of Mahesh here, and here it will appear on the debit side of Ojas. Okay? And who is credited? Naresh is credited. Now, Naresh is credited, but entire 12,000 we cannot show as credit, because in both 2 partners are debited. So, this 12,000 we have to show separately. Okay? 4,000 is of whom? Mahesh, and 8,000 is of Ojas. So, this credit will come here on the credit side of Naresh account. Okay? 4,000 plus 8,000. So, total credit will be 12,000. I hope this is clear to you. So, how do we record this? On the credit side, it comes in the Naresh column by Mahesh capital account. Okay? It will come as by Mahesh with 4,000 and by Ojas capital with 8,000. And on the debit side, it will appear only once, that is to Naresh, but in the respective columns of Mahesh and Ojas, that is 4,000 and 8,000 respectively. I hope this is clear. Okay? Now, we will see the next, where goodwill is already appearing in the books. What is the meaning of this? Now, you see, when there are 3 partners, the 3 partners have their balance sheet, isn't it? When one of the partner retires, at the time of retirement, there may be some goodwill appearing in the books. What does it mean? Goodwill is already shown in the balance sheet of the old firm. Now, when partner retires, it has to be actually written off from the books. Okay? So, goodwill has to be written off from the books, which is already appearing in the books. Okay? And for the purpose, we have to pass the entry, and then as usual we have to adjust the share of a retiring partner. So, goodwill has to be, goodwill already appearing in the books of the firm should be written off. Written off meaning what? It should be cancelled, it should not appear. So, usually goodwill is not to be shown in the books. It is already made clear at the time of admission to you that as per section 26, the goodwill should not be shown, and as soon as possible it has to be written off within the period of 1 year of that is which is existing in the business. So, here goodwill, let us see the journal entry for goodwill to be written off from the books. When goodwill is to be written off, we have to debit all partners, because retiring partner was also there, isn't it, earlier. So, all partners should be debited, because that loss of goodwill written off should be also shared by all partners, meaning even the retiring partner, including retiring partner. And goodwill, since it decreases, it is an asset, it has to be credited. Okay? So, all partners should be debited and retiring so goodwill should be credited. Now, we will see, suppose if a goodwill is already appearing in the books. Okay? Now, if goodwill is already appearing in the books, then we have to first adjust that and then we have to come to the adjustment of retiring partners goodwill. Okay. So, what is this goodwill already appearing or goodwill already existing? Meaning what? So, at the time of retirement there are partners, all partners are there before the retirement and they have their balance sheet. So, balance sheet shows some value of goodwill and that goodwill should be written off at the time of retirement, and then we have to adjust the share of a retiring partner. So, what is that written off? It has to be cancelled. It should not appear in the books of the new firm. Already it is explained to you in details, section 26 in case of at the time of admission of a partner. So, I will not go in details. I will just let us just concentrate that the entry to be passed on goodwill already appearing in the books. Okay. So, if goodwill is already there in the old balance sheet, then all three partners will share it, meaning it is to be debited to all partners capital accounts and credited to goodwill. Now, why we debit? Because it is a loss due to goodwill written off from the books and capital that is decrease, and therefore all partners should be debited, and goodwill is a asset. Okay. So, it decreases and therefore it should be credited. Okay. So, goodwill, and how do we distribute this? Of course, in the old profit sharing ratio. And next entry as usual you have to pass for adjusting retiring partners goodwill account, that you have already seen. I do not have to repeat that. Yes, very good. So, it is continuing partners capital accounts should be debited and retiring partners capital account has to be credited. Exactly. So, let us see the problem, one small illustration on this particular adjustment where goodwill is already there and retiring partner share also we have to adjust. Let us take one example now. Rama, Shiva and Bhima are partners sharing profits in the ratio of 5:3:2. एक मिनिट, पॉइंटर काढता है, एकच मिनिट, परत एकदा घेता, हां पॉइंटर राहिलो, आता घे, start. Let us take one example. There are three partners, Rama, Shiva and Bhima, who are sharing profits in the ratio of 5:3:2. Then their goodwill appearing in the books, already appearing in their balance sheet, is of rupees 60,000. Now, Shiva retires from the firm and goodwill is now rupees 42,000. Now, this is the goodwill already appearing, and at the time of retirement, if they revalue the goodwill and it is revalued at rupees 42,000. And now we have to see the journal entries, but before that we should know the calculations. So, this goodwill 60,000 plus the goodwill of the firm which is revalued is 42,000, but we are not adjusting this 42,000. In this we have to find out retiring partner share, that is Shiva's share, and then we have to adjust. So, I will show you the entire calculations first. Okay. So, here existing goodwill is how much? Existing meaning already appearing in the books at the time of retirement. So, already appearing is 60,000. Now, this 60,000 we have to write off. Yes. In what ratio? Very good. Old profit sharing ratio. So, now we know that old profit sharing ratio is 5:3:2. Okay. So, let us distribute it between Rama, Shiva and Bhima. Okay. So, what is the ratio? 5:3:2. Now, this 60,000 if you distribute, then what is Rama's share? 5/8 of 60,000, 3/8 of 60,000 and 2/8 of 60,000. So, if you calculate, then what are their shares you get? You get 30,000, 18,000 and 12,000. How did we get this? 5/8 multiplied with 60,000. Okay. Then 3/8 multiply with 60,000 and 2/8 multiply with 60,000. Now, after this, this is goodwill written off. Okay. This calculation. Let us see the calculation of retiring partner share of goodwill. Okay, we have to calculate. So, what is the total goodwill given to you? It is given as rupees 42,000. And then what is Shiva's share of goodwill? It is, his share is 3/10, isn't it? His old share is 3/10. So, 3/10 multiplied with 42,000. What is his share you get? You get his share as rupees 12,600. Okay, and this 12,600 we have to distribute between whom now? Remaining partners. So, who are remaining partners? Rama and Bhima. How do we distribute it? In their gaining ratio. Now, is the gain ratio given to you? It is not given to you, but should we calculate? This is the situation when only old profit sharing ratio is given. We take the gain ratio as same as old ratio. So, between Rama and Bhima, the ratio is what? 5:2. Their gain is 5:2. When this is the situation, earlier it was discussed with you, and this, if you distribute in the ratio of 5:2, what is their share you get? 5:2 meaning it is 5/7 and 2/7. So, what is their share you get? You get 9,000 and 3,600. Okay. So, same we will distribute between the partners, and then we have to pass a journal entry. So, let us see now the first journal entry for what is that? Goodwill written off. So, goodwill written off entry is what? All partners should be debited. So, we have already calculated, calculations were shown to you, 30,000, 18,000 and 12,000. So, all should be debited, and goodwill has to be credited because goodwill decreases. And Shiva's share we have to adjust also. So, what do? We debit Rama's capital account, and we debit Bhima's capital account, and we credit Shiva's capital account. And how do we distribute it? It is distributed in the gain ratio. Okay. So, this is already explained to you, how to adjust retiring partners goodwill share. Okay. So, let us see now the same how it appears in the ledger accounts. Okay. So, in the ledger accounts, again the first journal entry is what? This is the first, goodwill written off. All partners should be debited, isn't it? So, Rama is debited with 30,000, Shiva is debited with 18,000, and Bhima is debited with 12,000. This is for goodwill written off. Already mentioned here, goodwill is written off. And then that retiring partners goodwill, how do we distribute? In the ratio of 1:2, that is gain ratio. It is like a contra entry because we are opening columnar capital accounts. So, Bhima should be credited with 9,000 and 3,000. So, how do we write it? By Rama's capital and by Bhima's capital. And the same entry will also appear here on the debit side as to Shiva's capital and 9,000 and 3,600. Okay. So, hope this is clear. Now, let us see now the next adjustment. So, goodwill treatment is only this. So, what have we seen in goodwill? We have seen that how to adjust the goodwill share of a retiring partner. Now, when retiring partner has to be compensated by gaining partners in their gaining ratio, and therefore, gaining partner should be debited and retiring partner is credited. So, this we have seen. Then second situation where we have seen goodwill already appearing in the books. So, if goodwill is already existing or appearing in the books, we are writing off the goodwill to all partners capital accounts, that is by debiting their accounts, okay, and in the old profit sharing ratio. And then as usual we adjust the retiring partners goodwill account, okay. So, in their gaining ratio. So, let us see the next treatment, that is treatment of accumulated profits and losses. So, all of you know what is accumulated profits and losses. So, what is accumulated profits and losses is, now you see every year where profits, firm is earning profits, and out of that the profit is accumulated, and this is because of the efforts of all partners, the profits are gained, and instead of distributing the profits are accumulated. So, also the losses, meaning they have not distributed it, and when a partner retires, he is also supposed to get whatever share in the accumulated profits, and he has to even bear the losses and that has to be done in the old profit sharing ratio. Okay. So, we have to adjust that before he retires, because he is getting his share in everything what he has in the firm, isn't it? So, these undistributed profits should be distributed between the partners. Same about the losses. So, there are other terms like reserves and reserve fund for profits. So, let us see now. These retiring partner has to get his share in the profits, reserves or reserve fund, which are already existing in the firm, that is appearing in the balance sheet of the firm. So, also he has to bear the losses, okay, and this has to be distributed to all partners in their old profit sharing ratio. Okay. So, we will see now what are the journal entries we pass for the same. So, of course, all of you know when profits are distributed to partners, the capital increase. So, capital accounts are to be credited and profit or reserve should be debited. And when losses are there, the capital will decrease. So, capital has to be debited and profit and loss account has to be credited because the loss increases. Okay. So, here these are the journal entries for accumulated profits or general reserves or reserves account should be debited, profit and loss account, sorry, and all partners capital accounts should be credited. And how do we distribute it? Of course, in the old profit sharing ratio. And for accumulated losses, we use only one term. Okay. For profits, we can use the terms like reserve, reserve fund, general reserves and all that. But for losses, we use the term profit and loss account only. Okay. So, all partners capitals accounts should be debited and profit and loss account should be credited. So, when you prepare the capital accounts of partners, so it will appear like this. Okay. So, all of you can see here. Now, you see this profit and loss is debited, right, and all partners should be credited. So, this will appear here. Okay. This will appear on this side. Okay, by general reserves or by profit and loss account, and we distribute each partner's share you have to show on their credit side. And this for losses, this loss has to be credited and partners account should be debited. So, here we distribute to all partners. Okay, how? In the profit sharing ratio. So, that will appear on the debit side. So, same thing you have to apply it while actually solving the problems. Okay. So, we will not go in details here for individual calculation because already the same thing you have learned in admission, but only difference between admission and retirement is what? In admission, it happens between the old partners and then new partner is admitted, but in retirement this profit share is distributed or loss share is distributed before partner retires, but that means it is between all partners. Okay. So, this is the only thing you have to remember. So, whenever there is profit or reserve, you credit partner's capital account when you prepare ledger accounts, and whenever there is loss, you debit it, debit partner's capital accounts in the old profit sharing ratio. Okay. So, now let us see the next adjustment, that is revaluation of assets and liabilities. Again, you have learned in details in admission chapter this revaluation of assets and liabilities. So, there is no much difference here. So, what is this revaluation of assets and liabilities? Now, when a partner retires, he should get his share in everything, isn't it? So, that means also in revaluation of assets and reassessment of liabilities. That means whenever assets are revalued, there can be gain or loss, meaning the asset increases, there is a gain, and when asset decreases, there is a loss. Okay. So, this gain or loss on account of increase or decrease in the assets should be distributed between the all partners, meaning retiring partners should get his share. Okay. Similarly, liabilities. So, liabilities also when you reassess the liabilities may increase or decrease. Okay. So, this liability increases, there is a loss, and when liability decreases, there is a gain. So, again this loss or gain should be shared by whom? Of course, the retiring partner. Now, which account do we open for recording this gain or loss? Yes, very good. It is a revaluation account, because you have already learned in admission that revaluation account, a separate account is open to record this increase or decrease of assets and liabilities. And whenever there is, once we record all this increase or decrease, then at the end this revaluation account is to be balanced to ascertain profit or loss. So, if there is a profit, we distribute it between the partners, that is all partners, in their old profit sharing ratio. Similarly, if there is a loss, all partners have to bear it in the old profit sharing ratio. Let us see now this is the only difference between admission and retirement. What is that? Distribution of profit or loss on revaluation of assets and liabilities. So, only those two journal entries I will show you. Other increase or decrease, there is no need because already you have learned in admission. We will see only the ledger account format, that is a revaluation account, when it is debited, when it is credited, and how the profits are distributed. Okay. So, what is given here? It is necessary to revalue assets and liabilities of the firm on the date of retirement. Okay. Because you see, retiring partner get his fair share in the firm's assets. He also, it also helps in smooth functioning. Now, increase or decrease in the value of assets and liabilities is same as in the case of admission, as I told you, and it has to be distributed, profit or loss on revaluation we distribute to all the partners. Okay. So, let us see this revaluation account, how it appears. So, whenever assets, see, revaluation account is similar to that of profit and loss account. Okay. This is just to adjust a profit or loss. So, it is a part of profit and loss, and therefore, here it is debited with all expenses and losses and credited with incomes and gains, like same like profit and loss account. So, when there is a profit, we will debit it, we will credit it, and when there is loss, we will debit it. So, let us see this revaluation account. It is given here in front of you. So, on the debit side, what do we show here? Liabilities and provision. Now, what is this provisions, like provision for bad dates and doubtful dates? So, all provisions treatment is similar to that of liabilities. Okay. The provisions are made for the future by the business out of profits, okay, for estimated losses or the future liabilities, unexpected liabilities which may arise as per the concept, prudent concept or conservatism concept. It is a policy of playing safe. Okay. So, provisions are similar to that of, treatment of provision is similar to that of liabilities, and that is why it is mentioned provision. So, all PBD, that is provision for bad dates, or PDD, that is provision for doubtful dates, adjustments are treatment is same like that of liability. So, liability and provision, when increase, there is a loss. So, we debit the revaluation account. Asset, when decrease, we debit the revaluation account. Asset, when increases, we credit the revaluation account, and liability provision, when decrease, we credit the revaluation account. So, and ultimately we balance the revaluation account, find out profit or loss, and distribute between the partners in their old profit sharing ratio. Here I have shown you the example of revaluation profit. Now, you see here I have shown with the arrows, it will make you clear like when we debit and when we credit. Okay. So, liability increases debited, provision increases debited, asset decreases credited, debited, and asset increases debited, and liability decreases credited. Okay. So, here all partners should be credited, and revaluation account should be debited to distribute the revaluation profit in the old profit sharing ratio. Okay. So, I hope this is clear to you. Then we will see the next, that is journal entries for distribution of revaluation profit or loss. Now, why I am showing you only these journal entries, because this is the only difference, because here what is given to you is all partners. So, always remember that in admission it is only between the two partners before admission, okay, but here before retirement it is between the all partners. So, therefore, here you will notice that whenever there is a profit, all partners should be credited, and whenever there is a loss, all partners should be debited. And revaluation account, another name for revaluation account is given here is profit and loss adjustment account. So, do not forget this. And when we transfer this profit or loss in partners capital accounts, it will appear like this. All of you please go through it. There is a debit and credit side. So here this is your debits. Okay, so on the debit side, what comes is loss. Okay, so all partners, this revaluation loss, so it will come here to revaluation account. And all partners, no, so X, I have taken the example of X, Y, Z. So X, Y and Z is debited. How do we distribute it? Of course, in the old profit sharing ratio. Okay. Then what you get is profit. Profit, where it will appear? Profit revaluation is to be debited and partners account is to be credited. So all partners should be credited and revaluation account is to be debited. So what is it? This is a profit in the old profit sharing ratio. Is that clear to you? I hope this is clear. And then when we actually solve the problem, you will come to know. In admission already in details you have learned it. So here only distribution of profit and loss on revaluation is shown. Okay.
Prudent Scholars, powered by Lupin Pharmaceuticals.